Well, good afternoon, everybody, and sorry for the short delay. We've learned with these sessions that they sometimes start off with not very many people, but once we get going, then it kind of fills up. So welcome everybody to this session. We did this session yesterday, and it was very well received. And it's all about the housing market and what we might be able to expect as moving and storage companies. And so, to run you through it, from 20CI, Matthew Iskandar.
Thank you very much, Steve. As Steve has sort of very politely explained, very much looking into the property market and how it's actually performed and what we think is actually going to look like next year as well. But who are we? Who's 20CI? So we're very much a property data driven company with multiple news sources using our data, such as BBC, Times, and a lot of property related industry news as well, such as Property Industry Eye and Negotiator, to name a few. But more importantly, some of the data that we actually provide goes over to number 10 Downing Street, so we're government approved data company. But if we look back at actually who we provide that, more leaning towards the BBC and the Times and overall news outlets, what has the press been talking about the recent property market? So if we actually look at a few of the quotes, it's all looking a little bit sad. Telegraph suggesting Britain suffers the biggest housing downturn since financial crisis. Bloomberg, UK housing downturn moves into the new phase with prices falling even faster. Times, will house prices keep falling in 2023? And The Guardian, house prices suffer the sharpest fall in 14 years. This is money. Two property experts go head to head, and one predicts a 35% fall by 2025. And The Express finally shouting out that call this a house price crash. Wait until the prices drop 30%. A bit doom and gloom, really, if we listen to the news and what they're suggesting. Rest in peace, the property market, if we listen to them. But what's actually happening? What is really going on behind these news articles and in your local areas as well? Some of the things that we're going to look at, we're going to look at transactions, supply and demand, prices, fall-through rates, the time it currently takes to sell a property, and the time to exchange, so the time it takes to progress that property's sale. So if we look at the transactions to begin with, so transactions, so at the minute with this data, we're looking from a January to September time frame, and transactions are actually down 19% compared to this time last year. But we all know this, and we knew that was going to happen, particularly with last year having the stamp duty freezes and the government really pushing the sales of properties. But more importantly, in 2023, transactions are down 12% against 2019. And the reason why we're using 2019 is because that was the last normal year we had prior to COVID. And everything's suggesting that we're leaning towards previous times of 2019 and before. But at 12% down compared to 2019, is that actually a significant decrease considering the amount of issues we've had over the last 12 months, starting with Liz Truss's mini budget, which I'm sure you all remember quite well, interest in mortgage rates increasing, really hurting the pockets of new buyers, the war in Ukraine, the cost of living crisis, and of course, more recently, the conflict in the Middle East as well. However, all of this happening and bringing a 12% decrease in the transactions, it's actually showing quite a resilient market, and it's showing that the market's actually keeping above where we thought it was going to be. Now, if we look at the transactions in that as well, looking at monthly levels, again, things are getting a little bit better. September was an improvement on the prior months versus 2019, and actually that was only a 7% decrease against 2019 as well. So again, not too bad considering what's happened. And again, considering the current high cost of borrowing at the moment with the interest rates going up, again, we're in for good signs. Supply and demand. So supply is going to be the new instructions for properties being listed up for sale, and that's actually gone up by 2%, although it's slightly lower than 2019 at a 3% deficit. Sales agreed, currently 14.5% lower than last year and 10% lower than 2019. But again, we expect these figures to come through, particularly with what's been going on over the last year. However, and again, looking into 2024, the outlook for transactions is starting to look better than it has been this year, and just purely because the sales agreed haven't fallen as many as transactions coming onto the market. Leading on to prices, always an interesting one to see. Property prices over the last few years as well. And I like looking at this chart that we can see because that is my entire adult life that I'm looking at there, which is quite scary really. But if we look at that chart, the latest transaction prices, which we gained some of that data from the UK House Price Index, and this is from August 2023, prices have actually risen. They've gone back up, only marginally by 0.2%, and 0.3% in the last month as well. Transaction prices did peak in September last year, but that was prior to the mini budget that came about, and we can see on the chart where that was and what came shortly after that. You can see there's a small dip just towards the end of that chart there, which is right in the time of that mini budget. Comparing to May 2023 though, it suggests there's going to be a slight fall in these prices, about 2.3%. But if we look at actually since COVID, there's been a huge increase in property prices, so a 2% drop is quite negligible really. Property prices are not, well, we don't expect them to fall by the double digits like some of these news articles are suggesting. It's more likely to stay under that 10% mark and stay within the single digit marks. And it's actually even questionable as to whether any changes are going to affect London and those surrounding areas. Yeah, Gregory, I think you're absolutely right there, shaking your head. It's pretty much going to stay where we're at. And either way, even if prices do come down slightly, it's not going to be like that for long. And the reason being, there just isn't enough properties on the market. So at the moment, and according to the Centre for Cities, the UK's currently got a backlog or a deficit of just under 4.5 million properties. Keir Starmer, wanting to have 1.5 million properties built over the next 4 to 5 years, should he come into power next year, if that election happens. It will leave around a commitment of 300,000 properties, new homes to be built. But it's not that much really against the 4.5 million backlog. So if we look at that pace, which pretty sure we're actually currently behind the 300,000, it would still take 14 years to hit that target. So I think you guys are, there's going to be something there for you. And again, like I'm saying, currently the government is way off of this pace to achieve what they're looking to get. So the housing stock shortage isn't going to end anytime soon. And assuming no economic factors are coming into play on that as well. Fall-through rates. I know this is quite a sticky subject, a sore subject for removal companies, as the percentage of all fall-through rates has increased since the mini budget, and then it dropped off. So it calmed down a little bit, but it then did rise again by 1%, so ever slightly in October this year, so this month. If we compare this year's fall-through rates against 2019, we're actually worse off by about 22%. So there's a decent amount of fall-throughs coming through. Now, in actually October, this rose again slightly to 25% of the property sales going through. Now, out of those 25% of those properties, we do see those coming back up to go sold again, up to about 75% of those. So essentially 25% of 25% isn't really going to hurt the market too much with regards to the fall through rates. Because again, if it is falling through, 75% of those, they're coming back on and they're reselling. Those other 25%, if that's not coming back onto the market or that's not reselling, typically that's going to be due to a factor that actually out of control of the vendors, and that could be rental properties that are currently being tenanted, or the vendor situation has changed. Maybe their financial circumstances, their AIP has run out on their mortgage, and they can't actually afford the new rates. But again, like I said, we recognise that the fall-throughs are not good for removal companies as well as storage. Now, if we look at the current time it takes to sell a property, the average days it takes is 62 days throughout the UK in 2023. Now, that is an increase of 46% off of last year. Last year being 43%, looking at that chart there. However, if we go back to the previous years and the norms of 2019 and prior, we're actually still selling those properties faster by about 17%. So we're still on the right track there. What happens after the sales? Well, we then look at the time it takes to exchange, so the time it takes for the conveyancing to go through. That average time at the moment is currently sat at just over 120 days, or just over 4 months. Now, this does represent a reduction from last year of 7%, and it does also need to be set against a 33% increase in time to exchange since 2019. Now, you'll notice on the right-hand side, it's split up into the regions showing you the average time. So if you're in Scotland, happy days, but we know Scotland do things a little bit differently. So realistically, the next best areas, North East, the Yorkshire areas. If you're in Northern Ireland, bit of a sore subject even more. But again, going down towards the south, just over 4.5 months is realistically where we're looking at. So what changed in 2023? What's been happening? Who are the movers? Where are they moving? And if we compare the movers of this year to the types of movers in 2019, and if we look at the geography and the property types and prices, well, we can see most people were likely to move into London, North East and Scotland, and less are likely to move out towards the east. Property types, well, more flats were being sold than houses, and the property prices valued at the lower end and at the top end are more likely to move as well, purely because those who had a lower end property saw the large increases in prices coming up, giving them a little bit better affordability, more money in their pocket, so they can move up that bracket into the properties. And again, that leads into the wealth spectrum as well. And again, both ends of that spectrum. Household composition, older and single owners are more likely to move, with young families likely to stay where they are, purely again, current cost of living. Now, if we look into the agents, who's selling the homes, who's listing them, well, there's actually less online agents currently these days against 2019. I think over the last few years there was a large boost of online agents, and then I think after COVID happened, when the property market all got bounced back, people wanted to go and see real human beings again and actually have that personal viewing. But what does it mean? It means that establishing or continuing to have good relationships with local independent agents is still good. Always recommend dealing with your local agent and seeing if you can get more leads and more interest from the people that they're dealing with as well. Now, look out for the rise of self-employed agents as well. This is something that's starting to have a rise of these. Renters. There's two big problems facing the rental sector at the moment. And firstly, there aren't very many properties to rent at all. And actually, if we go back to 2019, there's about just under 30% less properties hitting that market. And the second problem is the prices of the rental properties are shooting up higher than they ever have been before, as you can see there. So it goes quite nicely against the previous chart. So if I go flick back quickly, stocks going down, prices shooting straight back up as well, with the average rent just over £1,200 per calendar month for your property, meaning in the current affordability rates for that, you've got to have an income, a basic salary of about £40,000 per annum. If we look at the current average pay, I think it's about £32,000 a year for most people in the UK. So there's a big deficit there. Now, we do know that your renters are not necessarily the most popular customers on the removal side, but don't discount them, because whilst they're going up, property prices are going up, their expenditure is more looking towards those of a normal home owner. So they're more likely to still be able to have that spending. It just means that they don't necessarily have a deposit to purchase new homes. So they'll be likely moving from rented to rented. The future, what's happening? Where do we think the world is going to go next year? So, forecast into the supply of properties going forward, we expect to see a continued modest growth of these properties hitting the market as we move in. Sellers are getting more realistic about the prices they're advertising. I think a few of us have seen properties go up probably maybe 30, 40, 50,000 pounds more than they should have, because they're still holding on to the dreams of the COVID prices. But customers aren't willing to pay those prices anymore, so they're just being a little bit more realistic about what's happening. Volume, so new instructions, we're expecting about 1.6 million properties to enter the market next year, which is a small growth of about 2%. Just there. And again, you can see at the end of the chart, shown in red, showing that small increase going up as well. And again, leading back towards the 2019 and actually into 2020 figures as well. Demand. So whilst it's nice having the properties being listed, we do need the buyers out there. And the Bank of England we're expecting to cut or lower those interest rates at some point next year, hopefully by the middle of next year. And assuming that the consumer confidence is continuing to rise and people continue to spend, and the high street lenders are still being very competitive against each other in the rates that they're offering, we do expect a similar amount of transactions to complete by the end as what we've seen this year, shooting around 1.9 million. But it's still a small growth, which again, nice to see. Transactions in home movers. Well, 20CI, I've been shouting 1.1 million transactions throughout this year, and we're pretty much bang on the money for it. So I think next year, hopefully, we'll continue that shouting those stats, and I think they'll hit on the money again. Now, if we do look, given that sales agrees volumes, we can already see, and assuming that the lenders are competing with each other, we do see a small 7.5% growth in the volumes of transactions next year. So again, as we can see in the red, leading back up towards the 2019 levels there again, but slightly higher than 2020. Rental home movers, well, both availability and affordability will continue to become the hardest issue for renters within the private rental sector. And they'll stay put for longer. And more likely, I think, at the moment, you expected to see a renter stay in their property for up to 4 years or more. Previously, that would be a couple of years less. Now, there's not going to be a massive increase in supply because of the fact that renters are staying where they are and there aren't enough homes being built. So what's that going to do to the prices? Well, that's going to keep the prices up where they are or continue to rise ever so slightly, but we do expect the market to shrink ever so slightly within the rental sector by 5%. Now, as we come up to the end, we're just going to highlight here, if we go back to the very beginning, I think, looking back at these recent press, we're scrolling all the way through, back to the recent press, it's not as bad as what we were all expecting it to be. I mean, did anybody here have any thoughts on the recent press articles here? So what actually we've come out with? Sorry? It sells papers, absolutely. Oh, what's happened here? Sorry. Exactly. They've got their own agenda at the end of the day. So yeah, I think we're doing okay. So as we can see, keep calm, carry on, and things aren't as bad as what they're expected to be. Thank you very much. That is the end of my presentation.
Thank you, Matthew.
Thank you. Any questions anybody would like to ask?
If you have a question, please use the microphone so we can all hear you. Do you have a question? Just while everybody's thinking, yes, you do.
Oh,
madam.
there you go, one.
Wonderful, thank you.
Just a little question. If, according to your data, if old houses grow the same fast as new buildings, like price in terms of prices?
Yeah, so naturally within the property market, your residential properties, standard residential properties are going to continue to rise ever so slightly anyway. Your new homes, typically they have that premium of slightly being more expensive as well. So yeah, that's something that will, I think, continue to go through as we've seen over the last few years as well. So yeah,
Okay.
thank you.
So,
The expected number of properties to complete,
Yes.
I think it came out the last time at 1.58.
So that would be the new instructions.
Yeah.
Yeah.
Is there any way of finding out how many of those people move themselves?
It's a good question, and that's something I'll have to come back to you. To be honest with you, I don't think there's necessarily going to be a particular way to find out if somebody is going to be a self-mover without physically speaking to them, to be honest with you. But yeah, but if you don't market to them, if you don't speak to them, you're never going to know whether or not.
I think just to help out with that, if you speak to the BAR, I think they have some statistics that they believe are the numbers of house moves that take place, and if you correlate their figures with these figures, you might be able to work out what that is. But I don't know. You have a chat with Mr. Studd. That's the way to do it.
I bet you can't wait.
Yeah. Any other questions, anybody? I've got one that I want to ask, but just one in case anybody's plucking up the courage or thinking. You mentioned earlier on that the rate of growth in the market is relatively modest. I think 2% or something you said.
Yeah.
And of course, we're living with what are historically quite high interest rates at the moment. Is that prediction that you get, that red line that you get, is that prediction assuming that the interest rates stay as they are, or is it assuming that they will fall?
It's going to be sort of slightly in between, because whilst we do expect the competition between the lenders to keep those rates quite competitive, if they do drop ever so slightly, I don't think it is going to be a huge drop. I think this 4 to 6% in the interest rates, that's very much going to be the norm of what to expect. What I do feel like is the slight increase in those transactions is purely because people are getting slightly used to what's available in their pocket compared to over the last 6 months. So I think that's where that slight 2% is going to come from.
So they get used to living with it, really.
Sorry.
They get used to living with it.
Yeah,
That's
absolutely.
I
Absolutely.
understand. Okay. Any other questions before we close? No? Good. Thank you. Matthew Iskander. Thank you very much.
guys. And if you do drum up any questions, we're over at H1, so feel free to pop over. Thank you.
Thank you very much. The next session will start in 15 minutes, and we're talking about security in self-storage. If you'd like to find out more about that, we'll be here in 15 minutes.